Hi, this is Andy from Rookie Investor, and in this video, we will analyze how to read a financial statement. Financial statements are written records that convey the business activities and the financial performance of a company. The statements are often issued quarterly and annually. A financial statement is broken down to three important financial documents: the income statement, the balance sheet, and the cash flow. To properly analyze the financial health of a business, we need to pay attention to each of these three documents and focus on some key points that will unveil if the business is profitable and in good standing or not. In this video, we will go over all three financial documents, explain the main categories, how to read them, analyze them, and check a few companies as examples. Allow me to start by saying that you can access any quarterly financial statement or 10K of a publicly listed company. Many websites, aside from the company's own website, will provide access to these documents. The easiest way to access a cash flow statement of a company is through Yahoo Finance. Once on the company's page, click Financials, or TradingView, which again you click Financials once you have picked the company. There are a plethora of investment related websites where you can get this information, and of course, you can visit the website of the company and find them there. For this video, we will use TradingView as it provides detailed information about all the listed companies as well as some key metrics. In general, if you decide to look on an original 10K form or income statement on the company's website, you will not have the luxury of looking at the numbers over the years or other stats. Thus, we use third-party websites like TradingView, which gives us a better insight as well as 7 years of data, so rather searching for them, we can get them right away and easy. The first financial document that you will find reading a quarterly or an annual report is the income statement. An income statement will show you the profit or loss of a company generated over a certain period of time. It focuses on four key areas: revenue, expenses, gains, and losses. It is by far the most populated part of any financial statement, and you could get overwhelmed just by looking at it. But after we break it down to parts and point out the sections you need to focus on, it will seem much easier. All income statements start with the total revenue of the company, which is also called the top line since it's the first number on the income statement and is the money the company made from selling its goods and services. In our example, we use Amazon, and their figure is $469.82 billion for the year of 2021. It goes without question that every company has expenses to operate, produce, and sell its products. Those costs are summarized under the name of total operating expenses, and in the TradingView format, this figure will be found on the bottom of the report. For 2021, Amazon had $444.88 billion in total operating expenses. Now let's turn our attention to gross profit, what it is, and how it is calculated. Gross profit is the profit a business makes after subtracting all the costs that are related to manufacturing and selling its services or products. In the TradingView, this bears the name cost of goods sold, and its value for 2021 was $272.34 billion for Amazon. There is always a minus sign prior to the number, as this number is always negative. Once we subtract the cost of goods sold from the total revenue, we will get the gross profit. In our example, that number is $197.48 billion for 2021. Moving down the statement, we have the operating expenses, which, as you can guess, are expenses associated with running business operations like paying salaries, advertising, rents, office supplies, and so on. These expenses are not taken into account in the cost of goods sold and need to be further deducted from the gross profit in order to get the operating income. So as you can see, from the $197.48 billion Amazon made in 2021, if we subtract the operating expenses, we get the operating income, which is $24.94 billion. Amazon is fortunate enough to have some non-operating income. In many companies, this is usually a negative number, as it was for Amazon in the past few years. This section includes interest paid on debts, and this is why the majority of companies have negative non-operating income. When you see a positive number here, this is income that has been generated from activities not related to its core business operations. This usually is dividend income, gains or losses on investment the company made, and so on. Adding operating income with non-operating income will give you the pre-tax income, which is the company's revenue after we deduct all operating and non-operating taxes, which is considered a more accurate measure of business performance and health. As it is well known, all companies have to pay taxes, some less than others, but in our case, Amazon for 2021 paid $4.79 billion. Deducting those from the pre-tax income will get $33.36 billion. The net income of the company, which is the most important financial metric as it reveals how much money the company made after all costs. It is also called the bottom line since it's the last number that can be found in the income statement. Again, TradingView uses a different format, but all the numbers and columns of the actual report can be found here. Now that we went through the income statement, let's focus on the key metrics that determine if the company is strong or weak financially. First, the total revenue, which as we mentioned is the money the company made after selling goods and services. A solid business will have its total revenue increase over the years. Second, the total operating expenses, which are the total expenses that are incurred over a given period of time as a result of normal business activities. This number needs to always be lower than the total revenue. If it is not, it is a huge red flag for the health of the business. Third, the gross profit, which is the profit a business makes after subtracting all the costs that are related to manufacturing and selling its services or products. We want to see a positive and a growing number here as well. Fourth is the operating income, which is measuring the amount of profit generated from business operations after deducting operating expenses such as wages, depreciation, and cost of goods sold. We want to always see a positive and a growing number over the years here as well, as this means the company is making profit. A negative number here means that the company is operating at a loss. In our example, Amazon is producing a solid $24.94 billion for 2021, which means the company is generating profits and they are up from previous years as well. Fifth, net income. As we mentioned above, the most important metric in the income statement is the net income. Solid companies will always have a positive and a growing number in this section. Last, two metrics that are highly advisable to calculate and are good indicators to analyze a company's income statement are the gross margin and the operating margin. Gross margin shows whether the company's sales are enough to cover their costs. To calculate the gross margin, you need to divide gross profit with gross revenue. In our case, these numbers are $197.48 billion divided by $469.82 billion. The number we get is 0.42, and since we refer to this on the percentage base, this is 42%. That means that for every dollar that comes to the company, Amazon makes 42 cents. The other metric to calculate is the operating margin, which measures how much profit a company makes on a dollar of sales after paying for variable costs of production, such as wages and raw materials, but before paying interest or tax. To calculate that, you need to divide the operating income with the total revenue. In our case, these numbers are $24.94 billion and $469.82 billion. The number we get after we do that calculation is 0.053. That means that for every dollar of sales, Amazon makes 5.3 cents. This also varies depending on the business. However, a 10% operating margin is considered average, a 20% margin is considered high, and a 5% margin is low. Typically, we want to see operating margin around or above 15%. To mention here that TradingView and other websites provide these metrics so you don't have to calculate them yourselves. If you click statistics, you will find many useful ratios, including the gross and operating margin. Now that we know the key metrics we need to focus on, let's quickly review a company and apply what we learned. Obviously, Amazon was a great example of an extremely healthy and prosperous company, but not all companies share the same fate. For example, Bed Bath & Beyond. Looking at their income statement and keeping in mind what we learned, we see that their total revenue has been decreasing over the years. That is a red flag as it shows a shrinking company, as each year it generates less revenues from the sales of its goods. Their total operating expenses are lower as well. However, the biggest issue here is that the total operating expenses are higher than the total revenue, meaning the company spends more than it makes. Gross profits are declining year over year, and the operating income is negative for 3 consecutive years. The picture already is painted, but let's move on. Same story with the net income of the company, negative for 4 consecutive years. Last, let's check the gross margin and operating margin. Here you will see that the gross margin is positive and it's above 30%, 33.31% to be precise, which means that the company is making profits from selling goods. This means that the company has high operating expenses, or as they call, selling, general and administrative expenses. These expenses are not directly related to the company's production process, but instead represent the costs related to sales, general and administrative functions that keep the company running. These are rent, utilities, marketing, accounting, legal, and so on. And it's quite true looking at the statement. Their operating expenses remain high relative to their revenues. Last, the operating margin, which as you may recall from earlier, we want to see a number of 15 or above, it's negative 1.57, meaning that Bed Bath & Beyond, for every dollar of sales they make, they generate a loss of $1.57. Needless to say if this company is considered a good long-term investment or not. The second financial document that you will find reading a quarterly or annual report is the balance sheet. A balance sheet reports the company's assets, liabilities, and shareholder equity. It gives investors a very strong insight in the company's financial position, what the company owes, and what it is owed. As you can see, I'm already in the balance sheet of Amazon. You have the option to see the annual version or the quarterly version as mentioned earlier. We will go with the annual one. Every balance sheet starts with the total assets, which basically reveals the value of everything the company owns and can be liquidated into cash within 12 months' time. That can be inventory, accounts receivable, equipment, copyrights, patents, and obviously cash on hand. Liabilities, on the other hand, are the legal debts a company owes to third-party creditors. These can be employee salaries, mortgage payments, loan payments, sales taxes, and so on. Last, we find the equity or shareholders' equity, which is basically what the company is worth after the company is liquidated and all the debts are paid off. Thus, the shareholders' equity equals assets minus liabilities. Now that we have analyzed the 3 basic components of a balance sheet, let me say that for a healthy and a strong company financially, the investors want to see that shareholders' equity is always positive. That means that the company has more assets than liabilities. There are exceptions, but best you stick with the companies that have a positive equity. Do note here that another term used for shareholders' equity is book of value. Now that we covered the 3 main categories on the balance sheet, let's dive a bit more into it and check the subcategories. Starting with the assets, they are separated into 2 subcategories, the current assets and the non-current assets. Current assets refers to all the assets of a company that can be liquidated to cash easily or are expected to be sold, consumed, or used through business operations within 12 months or a year. Examples of current assets are cash, stocks, inventory, accounts receivable, and so on. And if you expand the subcategories of the total current assets, you will see the cash, short-term investments, account receivable, and inventory are indeed there. And this goes for all the companies, not just for the Amazon that we're looking at the moment. All these assets can be easily turned into cash within the time frame of a year. Non-current assets, on the other hand, refers to the assets that the company owes but it does not plan to sell, consume or liquidate in other means over the next 12 months or a year time frame. These are long-term investments, property, plant, and equipment, as well as the intangible assets. I would like to expand a bit more on these assets and especially on goodwill, as it is associated with the purchase of one company by another. That means that a company can grow its goodwill value by purchasing other companies. For Amazon, as you can see, the figure has grown exponentially over the past 6 years, and from $3.76 billion is now $15.02 billion as the end of 2021. For example, let's assume Amazon wants to buy ABC company that is valued at $10 billion, but it pays $12 billion for it. That means that Amazon overpaid $2 billion to acquire the ABC company. That $2 billion will be added to the goodwill on the balance sheet. One main point to keep from this section is that since goodwill is basically a company overpaying for another company, For many investors, it's not considered as a real asset, and that goes for the entire intangible assets as they are consisted of assets like company's brand name, solid customer base, good customer relationship, good employee relationship, and proprietary technology. You can't really liquidate those, but they still have value. I mean, think about Apple products. The value of the brand name and the customer base there is insane. To note here that now that we talked about the intangible assets and goodwill, it is a good practice to remove them when you calculate the shareholders' equity. This will give you a much better, or as I like to see it, a much clearer view on the financials of the company. In our case, when you look at Amazon, their intangible assets are at 20.4 billion for 2021. If we subtract that number from the total equity, the new shareholders' equity number we get is roughly around 117.4 billion. That is also called a tangible book of value, and many investors are paying more attention to that number than the actual equity number given on the reports. Anyhow, that concludes our closer look into the asset subcategories. Let's turn our attention to the liabilities. Once more, we have current and non-current liabilities. Like the current assets, current liabilities refer to the company's debts or obligations that have to be paid within 12 months or a year. As we can see on the balance sheet, examples of current liabilities are short-term debt, account payables, dividends, income taxes, and so on. Again, current liabilities is the money that the company will have to pay over the next 12 months. The non-current liabilities is the company's long-term debts that will need to be paid, but it is not within the next 12 months. Examples of long-term debt are long-term loans, long-term lease obligations, pension benefits, deferred taxes, liabilities, and so on. In most cases, checking the total assets and total liabilities is a good start, and good enough for some people. However, it is a good practice to dig a bit more. I especially like to check where the majority of total liabilities come from. Is it from current or non-current liabilities? Because if a company has a high amount of long-term debt and their total assets are not in that great shape, how would the company be able to pay back its debts? And they will have to pay them back one way or another, so in that case an investment to that company wouldn't be such a good idea. Now that you have a much better understanding of the balance sheet, let's focus on the key metrics you want to look in order to determine if the company is in good standing or is in trouble. And since we are in shareholders' equity, let's start from here. The first point of focus is that we want to see the shareholders' equity number growing. And in this case, Amazon is a perfect example of a healthy company. Their equity has been growing year after year, and from around 13 billion in 2015 is at about 140 billion at the end of the last year. Their intangible assets such as goodwill increased as well, but again, if you do the subtraction, you will notice that the tangible shareholders' equity is on a very strong rise. That means that Amazon is growing at its assets on a faster pace than its liabilities. You will probably notice that the total liabilities are growing as well each year, and that it's totally normal as the company expands and acquires companies, the cost of operation liabilities in general is growing. However, as long as the total assets grow and the shareholders' equity is on a par with them, there is nothing to worry, as it is absolutely normal. Companies get loans, hire more people, acquire land, and so on to expand. So once more, as long as the tangible shareholders' equity grows over the time, the increase of liabilities is not an issue. The second point of focus is to check the current ratio. To do that, we divide the total current assets with the total current liabilities. For Amazon, that would be the 161.58 billion divided with 142.27 billion. The number that we will get is the current ratio, and in this case is 1.13. Current ratio is important as it measures the company's ability to pay its obligation within the span of 12 months or a year. You always want to see a number above 1 here, which means that currently the company has more current assets than current liabilities. In general, the higher the number is, the better the company stands. Current ratio is a very important metric for the financial health of each company, and you should always pay attention to it. A third point of focus is to check if over the years certain total cash and total current assets are growing. For Amazon, their cash grew from 16.18 billion to 36.48 billion, while their total current assets skyrocketed from 35.7 billion to 161.58 billion. And you always want to check both, as a company could liquidate non-current assets to increase its cash position without increasing its total current assets, so always pay attention to both. Now that we're familiar with the balance sheet and the key points you need to focus on, let's check one company for practice. We will use Netflix as an example. Netflix has been a company that thrived the past decade, and their shareholders' equity grew exponentially from 2.2 billion to 15.8 billion, which according to what we learned today, it is a great thing. However, paying a closer look to Netflix, we will spot a red flag based on what we learned today. Their total current assets are lower than their current liabilities for 2021. And to be precise, their current ratio was at 0.95, which is a red flag. The below 1 current ratio for Netflix means that the company does not have enough current liquid assets to pay off its current debts for the next year. So it is in a weak financial situation, and as you probably know, it was after the last quarter report of the year came out that Netflix stock really dived in price. The last point to check is their current assets and cash on hand. As we can see, their cash on hand took a significant dive of 2 billion in 2021, which is not a good sign. You could say that this happened back in 2016, but if you look closer, you will notice that the total current assets increased that year compared to 2021, that they declined as well. In addition to that, their total current liabilities continue to grow at a steady pace. Netflix only passes 1 out of 3 key points, so you can make your own conclusions. The third and longest financial document that you will find reading a quarterly or annual report is the cash flow. The cash flow statement summarizes the movement of cash and cash equivalents that come in and go out of a company. It measures how well a company manages its cash position, meaning how well the company generates cash to pay its debts obligation and fund its operating expenses. There are 3 main components to be found on every cash flow statement. Those are cash flow from operating activities, which is the amount of cash flow the business generates from daily operations, such as funds received from the sale of goods and services, interest payments, income tax payments, rent payments, and so on. Second, cash flow from investing activities, which is the amount of cash flow the business generates from investments such as buying or selling assets for the company, loans made to vendors or received from customers, payments related to mergers and acquisitions, and so on. Typically, the number in this section is negative as the company has to spend money to invest on itself or acquire other companies. And last, cash flow from financing activities, which is the amount of cash flow the business generates from taking new debt or raising new debt, as well as paying dividends and buy back stock. Typically, this number is negative as well. However, you will notice that in Amazon's case, this number is positive sometimes, like in 2017 and 2021, which is normal. That usually happens if the company is taking on debt or doing dilution to raise money. Another key component to take note is the free cash flow, which is the cash left after a company pays for its operating expenses and capital expenditure. This metric is very important and it serves as a measure of profitability, thus is a key indicator of the financial health of a company. Now that we covered the main components on the cash flow statement, let's dive a bit more into it and check the subcategories. Starting with the cash flow from operating activities, the first section we see is net income. As you may recall from covering the income statement financial report, net income is the money the company makes after deducting all the costs and the taxes. Next is depreciation and amortization. Depreciation refers to the reduction in value of a tangible asset like inventory and equipment, and amortization refers to the reduction in value of an intangible asset such as goodwill, licenses, trademarks, and so on. This is not a cash expense, meaning the company does not have to pay the amount in cash, but a loss in physical value. Still, it has to be accounted for that it has been reported on this section. Deferred taxes represent the company's negative or positive amount of tax owed. Changes in working capital tracks the net change in operating assets and operating liabilities across a specific period. To calculate the working capital, you need to subtract current operating liabilities from current operation assets. Working capital equals current operational assets minus current operational liabilities. A positive working capital shows that your business has sufficient liquid assets to pay off immediate debts, while a negative working capital shows that the company would struggle to pay immediate debts if restricted only to current assets. You can expand changes in the working capital and look at more categories such as account receivables, accounts payable, accrued expenses, inventory, and other assets. But the number to focus more here is the changes in the working capital as a whole. To summarize the cash from operating activities, you add the funds from operations with the changes in the working capital and you get your cash from operating activities. In Amazon's case, this was 46.33 billion for 2021. Moving to cash from investing activities, as mentioned earlier, is the amount of cash flow the business generates from investments. There are three subcategories in this section worth focusing on. The first one is the cash from purchases or sale of business, which reveals the cash received from the disposal of property, plant or equipment, business and or other subsidiaries, as well as the purchase of acquisition of a business. If we expand, we will see two categories as well. Usually that number for most businesses is negative. However, in Amazon's case it's positive as the company is raising quite the funds from the sale of fixed assets while it is spending quite a bit on buying new companies. The next subcategory is cash from purchase or sale of investments. Again, there are two categories in the list. One is the purchase and one is the sales. A company like Amazon is heavily invested in long and short-term investments, as you can see from the figure of money that is on the report, both on the purchase and the sales side. The third subcategory is the capital expenditures, which is key metric on the cash flow. Capital expenditures measure the funds used by a company to acquire, upgrade, and maintain physical assets such as property, plants, buildings, technology, or equipment. This number is important as this shows how much money the company needs to spend to maintain its current business. The last part of the cash flow statement is the cash from financing activities. These activities are broken down to four subcategories. The issuance of retirement of stock, which represents the net change in the carrying value of common and preferred stock. The issuance or retirement of debt, that represents the net change in the total debt of the company. The total cash of dividends that were paid out. Keep in mind that not all companies pay dividends. And last, other financing cash flow items that can generate cash for the company. Two parts to focus here. First, the issuance of debt. If you click there, you will get a new category, the issuance of long-term debt. If that number is negative, which is for quite a few years in the case of Amazon, means that the company is paying off its long-term debts, spending money towards that and reducing them. If the number is positive, means that the company is adding more debts, which as you can see it happened in 2021 for Amazon. If you click further, you can see how much debt Amazon added for the year of 2021 and how much the company spent towards reducing its debts. Second is the issuance of stock. In the case of Amazon, the numbers here are zero because Amazon didn't issue any stock for the past few years, so let's use another income statement to better explain why this category is important. Let's use Twitter. Twitter over the last few years has generated cash from selling common and preferred stock. For those who are unaware, the main difference between preferred and common stock is that preferred stock gives no voting rights to shareholders, while common stock does. Also, preferred shareholders have priority over a company's income, meaning they are paid dividends before common shareholders. When a company sells stock to raise money, they dilute the company's ownership, which has negative implications for a simple reason. A company's shareholders are its owners, and anything that decreases an investor level of ownership also decreases the value of the investor's holdings. Dilution also reduces the company's earnings per share, which often depress stock prices in the market. Now, as you can see, in Twitter's case, the last 2 years, the company is spending more money to buy back stock, which makes the stock more appealing to the shareholders. Now let's get back to Amazon cash flow statement and focus on the free cash flow, which is the cash left over after the company pays for its operating expenses and capital expenditure. As mentioned earlier, this metric is very important and it serves as a measure of profitability. Thus, it is a key indicator of the financial health of the company. The way this is calculated is the following. We take the cash from operating activities, which is 46.33 billion, and we subtract the capital expenditures, 61.05 billion in Amazon's statement. the number we get is a negative 14.73 billion. A negative free cash flow indicates an inability to generate enough cash to support the business. Now, in the majority of cases, this is a negative sign. However, that alone cannot determine if a company is doing good or bad. In the case of Amazon, the net income of the company is growing over the years, and the company is investing heavily on itself. So having a negative free cash flow for a year is not such a red flag. Now that we analyzed all the categories and subcategories of a cash flow statement, and we know what each one of them represent, let's talk about the key things that you want to see in them. First, the cash from operating activities. Over the years, we want to see that number growing. This shows that the company's operations over the years generate more cash, which means their business is growing. In the case of Amazon, that happened with an exception of 2021. And if you recall, that had a negative impact on the company's stock as investors pay significant importance on cash from operating activities. The same attention is given in the free cash flow, which once more we want to see a growing number over the years and definitely be on the positive side. That means that the company will be able to return more cash to its shareholders by investing more back to the business or buying back its own stock. Once more, Amazon was having growing free cash flows over the years, with the exception of 2021, and that, as we said, had quite a blow on their stock price. Last, it's always a great idea to pay attention to the capital expenditures, as these are the costs associated with maintaining existing property and equipment. Aside from the three key points mentioned, digging more to the subcategories can explain why some of the numbers make no sense and red flags come up. To apply all we learned, we will use Bed Bath & Beyond as an example. The cash from operating activities has been on a decline since 2016, meaning the company is generating less cash from its activities. Their free cash flow has been shrinking year over year as well, and in 2021 it turned negative. The issue here is that their net income is negative as well, and shrinking together it's extremely bad news for the company. Last, looking at the capital expenditure is rising despite the fact that the company is generating less cash from its operating activities. In fact, it's up to 354 million in 2021 from the 183 million in 2020. This is a terrible sign for the future of the company. Overall, the future of Bed Bath & Beyond looks grim with these numbers. But keep in mind that in order to determine the financial stability of a company, you need to look for the key points in the entire financial statement, which is broken down to three parts as we covered in this video: the income statement, the balance sheet, and the cash flow. I hope that this video really helped you familiarize yourself with how to read and analyze a financial statement and the key points you need to look at it. If it did, please hit the like button, and if you are interested in more content about investing, make sure you subscribe.